Hey, this is Ken at Capital Advantage Tutoring. It's my job to get you past this year's 66 exam and all the other exams. Okay. So I've done a quick and dirty. It's great. I have a Series 66 Blitz. I have a bunch of 66 videos. I have a whole crash course for the 66. So I'm doing a quick and dirty. And if it lasts an hour, I'll call it a power hour, but it's a 66 power hour, quick and dirty. Okay. I'm going to do like hard hitting stuff, just high target stuff, not worrying about, in order, it may be a little disjointed, whatever the word is. We're going to get this done. Okay. Also, there is an Easter egg in here. In here, there will be a way to access another video, which will absolutely help you get through this shit. I promise you, it'll be very high target, very helpful. You will thank me if you find that, but you got to watch the video to find the Easter egg. Okay. So now let's get into this shit. And again, there's no real rhyme or reason how I do this. So what's an IA? An IA is a firm that gives advice as business for competition. We know that shit, right? So a lot of it hinges on whether they give advice regularly for business or for compensation, right? So like if a publisher gives advice one time, and they don't get paid for it, it's not really, they're not an advisor. If a lawyer gives you advice one time or incidental, not an advisor, not an IA, not that stuff. That's where the plate comes in. PLATE. Publisher, lawyer, accountant, teacher, engineer. Okay, so now, when does an IA have to register? Well, we know when they have an office or more than 5 or 6 or more. Same thing. More than 5 and 6 or more retail clients means the same thing. Okay, now, if I'm an advisor, I have to register either the SEC or state. Now, remember, never both. It's never SEC and state, never. So if I'm a federal covered advisor, the only thing I'll ever have to do on a state level is notice file if I have an office or more than 5 clients. Now, remember something, place of business is the key word, okay? Place of business and where you regularly meet. It doesn't have to be an office that you pay rent at. If you regularly meet someone at a hotel conference room, that's a place of business, okay? If you regularly meet them at a Starbucks, that's a place of business, and you would have to either register if you're a state or notice file if you're federal, okay? Now, let's talk about a couple of things. So an IAR is an individual who works for the IA, right? That's someone who works for the IA. They give advice for compensation, either managing portfolios or doing that. Now, remember, a CFO not managing portfolios or soliciting clients is usually excluded. Little shit like that shows up a lot. Okay, if you are a CFO or a CTO or even a partner, even if you own 50% of the company, and you're not giving advice or managing portfolios, you're not an IAR. What's an IAR? Someone who gives advice or supervising those that do. Remember that. Okay. Now, if they say managing or soliciting to retail clients, and they don't specifically say 5 or less, you assume that it's more than that, and an IAR would have to register. Now, remember, IARs register on the state only, never federal. The SEC does not register individuals. So broker-dealers and IAs register with the SEC or not, and agents and IARs never register with the SEC because they're individuals. The SEC only does entities, okay? Now, a broker-dealer is a firm. They register SEC, FINRA, and the state. It's the only one that does all 3. I have that video where I talk about the quick and easy registration cheat sheet. It's good. I'm going to try not to do too much overlap because I want you to go the other stuff and then come here as a supplement. I'm telling you, there's an Easter egg in here. It's going to help you a lot. Now, an agent pretty much has to register SEC, FINRA, and the state. I always say agents always register. That's kind of my deal. Agents always register. I'm going to go with that. Unless an exemption applies. Even if they work for a limited partnership, the only time an agent wouldn't have to really register. Now, here's the thing. So we know my saying, no office, no retail, no register for broker dealers. Well, we want to add a caveat to that for the agents, okay? It's now no office, no retail, no broker dealer, no register. So again, if you're in the state and you only have institutional clients, if the broker dealer is registered there, you have to register. If they're not registered there, you don't. So if the broker dealer is exempt, so are you. Because again, if you have a retail client or you have an office, then that's actually the broker dealer's client or office, so they would have to register. Okay. So agents register pretty much all the time. The only time they wouldn't is if they work for the issuer and it's an exempt transaction and there's no compensation. Okay. Now, a lot of people confuse exclude versus exempt. Okay. Exclude means you don't meet the definition at all. Exclude means you're excluded, like when I was in high school. So exclude means you don't meet the definition. You're just not it. Like a future is not exempt. It is excluded. It is not a security. A real estate is excluded from the definition because it's not a security. Exempt means that you meet the definition, but you don't have to register. So like a treasury bond, the treasury bond is a security, but it doesn't have to register. A muni is a security, doesn't have to register. Investment company, stock exchange, all our stuff on a stock exchange, those are securities, but they don't have to register. So let's make sure we have this, okay? Exclude means you don't meet the definition, you're not a security. Exempt means you are a security, but you don't have to register. Now, under that, there's exempt security and exempt transaction. Exempt security means they issue exempt securities that never have to register, ever. Treasuries, munis, stock exchange, shit like that. Exempt transactions are for non-exempt securities. These are for securities that would normally have to register, but because of the way you're doing it or who you're selling it to, they will allow you an exemption, like unsolicited or isolated non-issuer, unsolicited non-issuer, by the way, selling to institutions, private placement, selling to underwriters, selling to employees, all kind of like not really selling to the public that much. Because remember, these rules were written to prevent the retail customer, grandma, grandpa, from being ripped off by the evil broker dealer and the evil issuer. And remember, some of these things are absolutely things and I've covered them a million times, but these are feedback. So even if it's something that's simple that I know is on there and I'm getting feedback, I'm going to bring it up. Okay. So if you're going to register as an IA, it's either federal or state, never both. If you're over 110 million, you're going to register with the SEC. If you're between 100 and 110, you're going to choose. Under 100 million, you're state only. Okay. Federal covered advisor, people have a problem with that, right? So understand, if you're 110 or more, you're federal covered and you have to register with the SEC. If you're managing a mutual fund, anything under the investment company in 1940, you have to register with the SEC regardless of your money, okay? If you're over 100 million in assets, regularly ongoing, you're federally covered, but you may not have to register because between 100 to 110, you can choose state or federal. Under 100, you're going to be state. However, this is where people get confused. If you're anything above, like, say, 25 million, you could be considered federally covered, but not have to register. Remember, federal coverage just means they addressed you in the SEC Act of 40. So if you're giving advice in more than 15 states or more, hold on. Right, 15 states or more, then you're federal covered and you're allowed to register with the SEC. If you're giving advice on an interactive website, like you're an internet advisor, you're federally covered. If you're a pension consultant, the pension is more than 200 million, that's federal covered, and you may have to register with the SEC, but you are considered federally covered, okay? So again, federally covered doesn't always mean you're registered with the SEC. It just means they've addressed your situation. Like an exempt reporting advisor, as long as it's under 150, they're addressed, but they don't have to register until they go to over 150 million. Okay, I'll be back, probably dressed different because I have a bunch of students right now. I'll see you later. Okay, so the next thing is we have the private fund advisor. This is an advisor that just advises private funds. I'm kidding. It is literally a for like hedge funds, PE firms, venture capitalists. As long as it's under 150 million, they don't have to register with the SEC. The employees may or may not have to register with the state, depending on the state, but they kind of are exempt. Okay, now moving on from that, if they are over 150 million, they have to register with the SEC unless they're advising venture capitalists. So if they do venture capitalists, they don't have to register no matter how much money they have. Now, here's the thing. That's an exemption. If you want to be exempt, you have to be eligible to register. What I mean by that is that if you are subject to suspension or statutory disqualification, you cannot use this exemption because you can't use it as a loophole to get around you being a shitty person. So if you are statutory disqualified or currently suspended, you can't do the exempt reporting advisor or pull some exemption shit out of your ass because it doesn't work. You have to be eligible to register to get an exemption. Okay. Now let's talk about solicitors. We know that solicitors only register on the state, not the federal level. However, they have to pretty much register in the state. You can have an agreement with them. You can pay them cash as long as you have a written agreement saying that you can pay them cash as long as you have a written agreement. Now, remember, solicitors are finding clients for investment advisors, not broker dealers. So you can pay them as long as you have a written agreement and pretty much follow the state rules, which means they'll have to register in the state. Okay. Now, let's say your client decides to go on vacation. You can still work with them, okay, if they are already your client. If you can't solicit new ones in new states, but if it is existing, then you can. Remember, there's an Easter egg, so stick with my shit. Now, if someone leaves the firm, you can no longer pay them commissions unless they have a written agreement before they leave that they're going to get commissions on existing clients. They can't, like, say you're going to leave, but you have mom and pop, and you have their clients, so you're going to get a piece of whatever they do with your firm. If all of a sudden their kid signs up after you leave, you don't get that. Even if it's from them and because of you, doesn't matter. You're not at the firm, you can't get paid. They do this so that people fucking retire at some point. Okay. Also, if you leave a firm, if it's a broker dealer, the agent tells the administrator, not really, they just make sure the U4 and U5 is signed, but the responsibility falls on the broker dealer you left, the agent, and the broker dealer you're starting with. IAs, it depends. If you work for a federal covered IA, you're responsible for it because the federal covered IA isn't in the state really, so they have no mechanism to report. And if you work for a state IA, then the IA that tells them you left. Okay. Now, if you want on your advisory contract, there's a couple of things that have to be in there that I'm seeing pop up. Again, I'm not covering everything. This is a supplement to the other quick and dirty, which I'll put a link somewhere, and what you're reading. Okay. So now, advisory contracts, you have to show how you're going to calculate the fees and all that stuff. You have to give the refund and penalty policies if someone terminates early. And you have to say whether you have discretion. Okay. You cannot guarantee performance. That's prohibited. Okay. Now, if you have a qualified client, then you can actually adjust the fee based on performance, but it has to be in the contract as a performance-based fee, and the client has to be qualified. Again, advisory contract is a contract between the advisor and the investor. So they don't care about the registrations. They care about what happens to me. So how we determine the fees, the refund and penalty if it's terminated early, if there is one, and whether we have discretionary authority, and we can't guarantee performance. 100% do that. Okay. Now, released 1092 just added a couple people on there, right, that are now have to register. If you're a pension consultant, a financial planner, or like sports or travel agents. Now, think of Jerry Maguire, right? So if they're touching the money, then they have to. If you're just negotiating contracts with them and you're not touching their money, then you probably don't have to register. But just in sports and travel agents, financial planners, and pension consultants now have to register, especially, remember, they're giving advice. It's regular, compensated, and it involves securities. If all they're doing is telling you how to sign the contract, your next contract with the Jets or whatever, why they would do that, I don't know. I'm a Jet fan. But that wouldn't fall under the thing. They're giving advice on securities. Now, broker dealers, agents, IAs, and IARs expire on the 31st every year, as opposed to securities, which are the anniversary date, right? So again, broker dealer, agents, IAs, and IARs, it expires on the 31st. That's when you renew. But it's securities, it's anniversary. So if you start in March, if you create your firm in March, and then as an IA or broker dealer, and then the following March, you re-register, you're 3 months late. You have to. So even if you start December 30th, it ends a day later. Now, if it's a security, it goes March to March to March to March. It's anniversary. Okay. Now, you would not have to register as an IAR if you're only providing like clerical work, ministerial, impersonal advice. Okay. And you're not compensated on the shit. Okay. So you're not an IAR. Now, what is an IAR? I might have done it already. Is someone who gives advice or supervises those that do. Okay. Now, what if you have custody? What is custody? Control of the assets. You have to bump up what you do. So what would the custody? If you're a trustee in the account, if you have full discretion, if you get money and don't forward a return within 3 days, if you accept prepaid fees of substantial prepayment of fees more than 6 months ahead of time, $500 for the state, $1,200 for the federal, that's considered custody. If you send your statements to the client instead of the broker dealer or the custodian, that's custody. Okay. All of those things are like to control their assets. I'm talking fast. I apologize. I'm trying to get as much as I can in this hour or whatever it is. Now, if you have custody, let the administrator know. Submit your financials. Submit to an annual surprise audit by a isolated auditor, like an independent auditor. Put up a surety bond. The surety bond is minimum 35 grand. But if your net worth for IAs or net cap for broker dealers is high enough over the 35 grand, they will normally waive it. Okay. What else you have to do? I think that's good on that. Let's see if there's anything else you need to add. You're gonna have to deal with my ADD on this shit. I think we're good. Surety bond. Let the administrator know. Submit financials. Audit. And send them a quarterly statement. Tell them where their money is. Okay. Now, if material info, if I'm selling you something, these are for clients. You know what? I'll come back to that in a minute. So the brochure rule. The brochure rule is this: you must have the brochure or the ADV Part 2 or the disclosure doc, same fucking thing, at or prior to signing the contract. That's the rule. The rule is at or prior to signing the contract. That's it. You do that, you're good. Now, the states go, well, that's okay. We're going to add a caveat to that. You must give it to them 48 hours before they sign the contract, or they get a 5-day rescission where they can just free look, where they can get out without penalties. Now, during that time, if you give them advice, you can charge them for the advice, but you can't penalize them. Okay. Now, that's the brochure stuff. Okay. Now, the exemption for getting a brochure is if it's a mutual fund as your customer or impersonal advice under $500 a year. And if remember, also, if you charge more than $500 a year in fees, then you also have to send them a balance sheet, no matter what. No matter what, if you charge more than 500 fees, you have to send them a balance sheet every year. Okay, now, that works. Now, let's say I sell you a security and I omitted some material information. The client can sue for rescission. It's basically for damage. It's agent, IA, IAR, broker dealer. A rescission is basically trying to get your money back. They can sue for that and say, listen, give me my money plus a little bit of interest plus lawyer's costs, court costs. Now, so remember, the definition of an IAR is someone who gives advice or supervises those that do or deals with clients. So a CFO or a CEO, unless they do that, is not. Now, if you work for a private fund, do the employees need to register? Pretty much no, because they're of that. They don't have to, unless they meet the definition of an IAR. Okay. So if you're selling limited partnerships, since it's a security, you're still an agent. If you're a broker dealer and you're on vacation, can you register? Yeah, as long as it's temporary residency, you can. Okay. We also know that state versus federal, right? When do you become a federal covered advisor? When you hit 110 or higher. Anything under 110 to 100 down, you can choose. Anything under 100 is state. If you go over 110, you're federal automatically, or if you manage mutual fund. So if you see, their customers a mutual fund, federal covered advisor, they throw that in as a trick. Remember, normally if you're above the 110 and you're federal covered, you will still have to notice file in any state where you have an office or more than 5 retail clients. Remember something. If you have no office on the BD, even one agent, even if you're a broker dealer, even one client, retail client, you have to register, right? But if you're IA, if you have 5 or less retail clients and no office, you don't have to register. If you're over 5, then you have to register. Okay, so remember, if you're 6 or more than 5, they're the same thing. Or if you're under 6 or 5 or less, you don't have to. Okay. 10Ks, 10Qs is more for these are not for advisors, but if you're an issuer and if you're a publicly registered issuer, you do a 10K annually that's audited and a 10Q, which is quarterly and that's reviewed by the auditor. When you do a CTR, that's a FinCEN Form 112 in case I say it. Once more than, not 10 grand, once there's more than 10 grand in cash goes in a firm or out of a firm. The brochure rule, you have to give it to them at or prior to signing the contract. That's the rule. But the states add on remember, that's the rule. That's your fine. If you are a state advisor, then they would like you to send it to them 48 hours before they sign the contract. And if you don't, they should get 5 days to cancel without a penalty. Now, remember, as I said before, you can charge them advisory fees, but that's that. Okay. Some of the exceptions, one of them is if it's a mutual fund. Okay. 2, if you're giving impersonal advice under $500 a year. Okay. if an IA sends statements to a customer directly instead of the custodian, that's custody. They have to get the surprise audit. We know what a CTR is, more than 10 grand. Remember, it's not about taxes, it's about detection. Okay. If you want to manage an account when the person is through incapacitation, right? So power of attorney, if it ends at incapacitation or death, right? But if you wanted to go through the incapacitation or coma, it has to be durable. Now remember, even a spouse that comes in and goes, "Oh, I don't have power of attorney, but my husband's in a coma," doesn't matter. You can't do shit. Now, one other thing I'm going to throw in there that keeps popping up. There's a thing called springing power of attorney. Springing power of attorney, okay? Springing power of attorney is, what's the best way to explain it? Springing power of attorney is where it goes into effect when you become incapacitated. So you have no control until capacitation, and then it goes into effect. It's kind of protecting you there. Okay. Churning, this is literally doing repeated trades for commission, not for the benefit. Excessive trading. And remember, first of all, in the IA, it violates a fiduciary duty. And a broker-dealer, it's an ethical breach and it violates suitability. Plus, they do not look at, what's the best way to do it? They do not look at gain or loss. They do not look at gain or loss to determine if it's churning or not. You can make money and be churning, and you lose money and not be churning. Okay, succession plans, right? So that's the plans when an IA plans to retire, dies, or loses capacity. You really do need to have one. And basically the whole point is that it meets regulatory compliance and it ensures client continuity. So the clients will go, wait, what am I doing now? Okay. If you're splitting commissions with agents of the same broker dealer, you do not need consent. Now remember, they have to be the same broker dealer or affiliated and equally registered, meaning that you're registered in the same states as a client. Okay. Again, we're jumping around all over the place, baby. Okay. Market manipulation, pump and dump. That's where you talk about it, get it up, and then you dump this shit. That's like Jordan Belfort. Painting the tape, wash sales. No, painting the tape, wash trades. That's where you put trades on without trying to change ownership. You're just trying to increase volume to make it look better. You're trying to create false volume and price movement. Okay, so that there's going to be customer. I keep saying this. There's going to be joint account stuff in this. I promise you that it'll be there. So let's talk about a couple of them. We have joint with rights of survivorship. That means both. It doesn't have to be married. If the person dies, the other person gets the money, even if it's 3 or 4 people. Avoids probate. Boom. Tenants in common. Each owner has a defined share. It goes to your heirs, not the surviving person. But it's both of them are undivided accounts. Anyone can place orders. Any checks have to be written to both people. But if you die in a tenants in common, your money goes to your estate, your heirs, your beneficiaries, or just goes to probate. That's kind of what you have to think about, right? Moving on. Transfer on death. It's for individual accounts. Mostly it can be a joint. And it basically avoids probate because it says, hey, when we die, this money, this account, all the stuff in this account goes to this person. It avoids probate and it supersedes the will. Remember that. Now, what's another one to go? Tenants in entirety. Tenants for the benefits of, I think it's a TBE account. That's for married couples only. And the whole point is that it protects, it's for property. If you have property and you're a married couple, you have an entirety account. It protects that property because if I get sued because I did something stupid, they can't touch that property unless both of us are creditors. Okay, moving on. A living will is not about assets. It's about medical directives when you're incapacitated, whatever. Okay, so now, like, kill me, don't kill me, whatever it is. Per stirpes passes to, remember, so per stirpes is by the branch. It goes to all the heirs, the heirs and the children, everyone alive, it goes to the branch. 3 kids, 1 dies, it still goes to their family. Per capita, it's split equally among the living people. Okay, now, customer identification program. You verify before or during the account opening. You need name, address, date of birth, social security number. That's part of, my chair is fucking squeaking like hell. That is part of like an AML program. Again, random shit. Okay. Cost basis. Remember, cost basis is what you pay. If you die, say I buy stock at 20 and I die when it's at 30, whoever gets it at 30, not 20. They get the stepped up cost basis. Annuities do not step up cost basis. Again, random shit because it's high target shit that's popping up. Okay, now, if I buy stock at 20 and then I give it to you when it's 30, you're going to get my original cost basis of 20. So if you sell it at 30, 35, you're going to pay taxes from when I bought it. And it's long or short depending on from when I bought it. If I die, it's automatically long term. I'll do that. So on if I buy stock at 20 and it goes to 30 and I die and you inherit it, you get it at 30 and it's automatically long term. If I buy stock at 20, it goes to 30 and I give it to you, I haven't died yet. You're getting it at 20 and it's long or short, depending on how long from my date of buying it. Okay. That your cost basis will stay where I bought. Okay. CAPM is a risk adjusted return. If you need to do the math, it's the beta, whatever the market is. If they give you a risk free rate of return, whatever the market is, subtract the risk free rate, multiply times beta, and then add the risk free rate back in. It's beta. CAPM is the beta formula. Okay. It's market return times beta. If you have to take out the risk free rate, take it out first, multiply, and then add it back in. Alpha is what you do better or worse than that. Okay. So if you have a positive alpha, you do better than that return. If negative alpha is, you do worse than that return. Okay. Strategic. Okay. Strategic is strategic versus passive. It's sort of the same thing. Strategic is long term. I'm not going to touch that one. Okay. Just remember, strategic is more passive. It's like you're thinking big picture. Tactical is you're trying to move shit around. Okay. So you can even have a portfolio that has a strategic portfolio, but it's tactical to move stuff around. Okay. Good stuff. Okay. Don't care. Don't care. Don't care. Don't care. Okay. Efficient frontier. You don't have to know the math, but it's a concept. The concept is the efficient frontier means you're getting the efficient frontier is like the right amount of reward and risk. Like it's under modern portfolio theory that you're trying to increase the return without increasing the risk. So if you move ahead of the frontier, you're doing better. You're earning more than the risk would go. And if you're behind it, you're kind of inefficient. Okay. Discount cash flow, DCF, is to find present value. You might have to do the math. Find my time value money video. Discounted cash flows for bonds and projects. Dividend discount model is the method to find present value for stock. Now, dividend discount model is more for preferreds. Dividend growth model is for stocks that pay dividends. If a stock doesn't pay dividends, you can't really do it. Okay. So again, DCF is for bonds and projects to find present value, which is fair market value. DDM is for preferred stock for the most part because it's dividend, and dividend growth model is more for growth stocks. I mean, for stocks that pay dividends where the dividend may go up or down. Okay. Duration is volatility, right? Long-term bonds have a long duration. Short-term bonds have short duration. But also, low coupon bonds have long duration. High coupon bonds have short duration. Duration is volatility. Okay. Now, you know how to do current yield, AMP, annual over market price. You should fucking know that by now. Annual over market price, that's that. Don't forget, I got an Easter egg coming. Pay attention and deal with this fucking rambling, chaotic shit that will absolutely give you points on the test. The Easter egg will be coming soon. I promise you it's worth it. I promise you it's worth it. Okay. Now, current yield is annual over market price. If you have a discount bond, it goes coupon, then current, then yield to maturity, then yield to call. Okay. If you have a premium bond, it's the other way around. Coupon, current, yield to maturity, yield to call. It's much more about the concept than the math. So if they say, if you have a discount bond and the current yield is at, if they say what's yield to maturity, it has to be above that. Okay. If it's a premium, it has to be below. Okay. You need to know that tips. You may have to do the math. I have a video on this, I think, in the burning math. Tips. Remember, it's going to adjust the par for inflation. So if you have $1,000 bond and inflation is 4%, you're going to increase the par value by 4%, 1,040, whatever the coupon is, it is out of that. Okay. So the coupon is out of the new number. So if you buy $1,000 5% bond and inflation is 4%, your new par value is 4%, 1,040, and you're going to get 5% of 1,040. Okay. That's tips. Remember, they fight inflation. Total return is your growth plus income, right? So basically, if you buy something at 95, it's now worth $100 and you get a $3 dividend. That's $5 because of the growth plus a $3 dividend. I have questions on that. $8 divided by 9 is like 8.4%. So again, total return is your growth plus your income divided by the original. Now, if you ever see anything about ESG, it's environmental, social governance, whatever it is. This is like a client avoids a tobacco stock due to personal reasons. That's non-financial value-based restriction. That's a non-financial base. That's like, oh, I don't like them. I want you to not invest in tobacco. So almost like you wouldn't have a far left liberal invest in Monsanto, and you wouldn't have a far right person invest in stem cell research. It's just not a thing. Okay. Now, retirement plans. Remember, 457 plans are non-qualified. They're for like firefighters, cops, state workers. If you remember, here's the big thing: since it's non-qualified, they can take it out earlier. Okay, they don't have a 10% early withdrawal because firefighters may retire at 45 or 50 and they want to be able to touch that money, so they can take it out before 59 and a half without a penalty. It's for state and local government workers and for the higher end people like hospital workers, fire, police, stuff like that, not teachers. If you have an IRA, you pay a penalty if you take it out, unless it's for a qualified reason. You're 59 and a half. For education, first, not primary home, first-time home buyer, medical, like disability, shit like that. Okay. Remember, it's not for your primary home. It's for your first-time home buyer. You don't pay the penalty. Usually with the Roth, you have to hold it in there for 5 years and take it out without taxes. Okay. Fundamental is the no fun, right? No fun. Okay? No fun. That you're looking at balance sheets, income statements, financial ratios, earnings per share, PE ratio, industry trends, all the stuff about the company. Technical analysis is looking at the trading. Think technical for trading. That's like overbought, oversold, resistance, support, trading momentum, shit like nothing to do with the actual company. Again, CAPM measures return based on the risk premium times, I guess it's risk-free rate. Don't worry about that. So it's going to be, you take the risk premium, which is the market return, minus risk-free rate, times beta, and then you add it back in. Okay. Efficient market theory. The weak reflects as all the past data is built in and fundamental may work. Semi-strong, all public information is built in, but private is not. Strong, all information, including inside information, is built into the price. So they all kind of believe in buy and hold, especially semi-strong and strong. But weak does believe that maybe if you do fundamental, you might be able to get into it. But remember, weak reflects all the past data is already in there. Annualized return, okay? Holding period return is basic. So holding period return is like total return. And then you annualize it. So let's say you earn 5% over 4 months. Well, 4 months happens 3 times in a year. So you're going to do that return, say it's 5% over 4 months. You're going to multiply that times 3 to get annualized at 15. If you earn 5% over 6 months, 6 months happens twice. So you're going to double it, so now it's 10%. Okay. If you earn money over a year, if you do a total run for 2 years, annualize is bringing it down to a year, so you cut it in half. Okay. If you want to add leverage, you're going to use margin or leverage ETFs. Remember, it may not be suitable because it increases your risk. You do not get, remember something, you do not get leverage without risk. Anytime you have more leverage, either margin or leverage ETFs, you are increasing your risk. Okay. Okay, if you have a promoter or solicitor, if you pay them over $1,000 in 12 months, you must have a written agreement and disclosures, okay? You have to have a written agreement and disclosures. They used to need client consent. Now they don't. You just have to disclose all the conflicts of interest. If you have an advisory contract, it must include the fee structure. If there's discretion, a disclosure, the refund policy, and no performance guarantees, okay? Now, an IA can have oral discretion. He had an oral for 10 days. How happy is he or she? Okay. So the point is, an IA can have discretion orally. God, that sounds so bad. For up to 10 days. And then at the end of 10 days to continue, and you need it in writing. Broker deals and agent have to have it up front in hand. Okay. Now, again, back to this. It goes back to this. So I have a lot of stuff repeating, right? So durable power of attorney goes through incapacitation. If someone's in a coma incapacitation and they come to you and say, hey, they want to do trades, not unless I had durable power of attorney. If I had regular power of attorney, it's gone. Okay. Now, ADV Part 2, the brochure has to be updated every year, annual updating amendment, and any material changes promptly. whatever the fuck that means properly. Okay. Soft dollar. It's good for research, software, and seminars. Office furniture, not. Salary, no. Stuff like that. Okay. You remember the elder stuff, like you got to make sure that you know that you have to look for red flags, like if they come in and they want to withdraw their money when they didn't do it before, if they say my caretaker is going to help me invest, stuff like that. And if you think something's wrong, first you can do a 15-day hold, then a 10-day hold, then up to 30, so a total of 55 days. If you think they're actually being abused, you have to call I think it's a senior care hotline or something like that. Okay. Remember, front running is always a violation. It's never not a violation. Okay. No, insider trading, being in possession of insider trading is not the crime. Acting on it is. Either, and remember, it's like treble damage. It's like it's three times gains or any loss you avoid. Okay. We talked about efficient market theory, modern portfolio theory. Okay, got it. Okay. Top-down analysis. So top-down versus bottom-up. Top-down analysis is when you look at the economy, then the sector, then the industry, and then the stock. You're using the economy to make decisions. Top-down. Bottom-up is you look at the stock, to the industry, the sector, the economy to make your decisions. Okay. Correlation. Correlation is if it's between 1 and -1, right? 1 all the way down to -1. 1 means they move, the two things correlated, they move in lockstep. 0 means they have nothing to do with each other. That's real diversification. -1, they move opposite. That's not diversification, because if one goes up 10, the other goes down 10. How do you make money? Because they're offsetting each other. Okay. So again, correlation, you want like 0 to maybe a little bit of negative, but you don't want correlation because that's diversification. Because if they move together, you're not diversifying. Always remember, strategic is more of a long-term target mix. Tactical is short-term, moving with the markets, like sector rotation and shit. Okay. If you do a trade and you don't mention a method, the IRS will automatically base the cost basis on FIFO. You can do share identification. If you have a non-qualified retirement account, usually like an annuity, when you take the money out, they do LIFO, which means the growth comes out first. Oh, my eye is going to blow up. There we go. Okay. If the exam doesn't specify which shares are sold, assume FIFO. Okay. Again, ESG, I don't want to buy tobacco company. Remember, ESG considerations are not tied to performance, but the investor's personal beliefs. Okay. IRA, premature distribution. I'm not going to say that other thing. Qualified exceptions are first-time home buyer, qualified education, disability, death, substantially equal payments. That's like annuitizing it. Medical expenses over 7.5, and health insurance if you're unemployed. Okay. Now, we talked about firefighters. Now, if you have a retirement plan, you need an IPS, not IBS, like you got to poop all the time. IPS, investment policy statement. It's a written document outlining the objectives, the time horizon, risk tolerance, and asset allocation. So basically, you personally can have your own investment policy statement saying what you want to do, but all qualified retirement accounts have to have this. An IPS, which is objectives, time horizon, risk tolerance, and asset. It's in writing. And any kind of plan, a RISA plan, whoever manages it has to follow the prudent investor rules. Remember, when you're managing an account and you have a trustee or you're a fiduciary, it's not always so much that you have to get the safest thing. You have to do a trade. So you can put crypto or NFTs, don't put in there, but you can put digital assets in it or futures in account if you think it's worth it. Now, let me explain something to you. My little Easter egg here, okay, that you had to suffer through to listen to. But say it once. I have basically probably 150 questions that are very, very similar to the 66. They're going to be at the end of this video. But what I'm going to do is I'm going to have like a 5-minute gap from when I stop talking. Maybe I'll play music or something until the thing starts. So all you have to do is wait to the end and then listen, go through the 5 minutes, and then boom, you have over 150 questions that really have a very, very high chance of being very close, I'll say that, as being on the test. I'm not saying they're word for word. I'm going to say they're going to give you the same vibe. It's like my Series 7 brutal exam, but for the 66. And I'll mention that again later in case you miss it. Behavioral and risk concepts. Okay, political risk, instability due to elections, coups, nationalization of like oil rigs and shit like that. Duration is sensitivity of bond prices to interest rate. That is interest rate risk. Longer duration is more interest rate risk. Okay. 529 versus covered house. 529s, state, higher contribution limits, no income limits, no age limits. But you can use, soon it'll be for everything. But right now, you can use it for any college education and up to 10 grand for primary. That's going to change next year, but whatever it is. No income limits. The contribution limits are very high. The only problem is you can't invest in specific securities. You do like funds and portfolios. Covered L is run by the federal government. So, by the way, 529 is covered by the MSRB. It's considered a muni fund. Covered L is run by the federal government. So it knows how to stupid rules. Income limits, contribution limits of $2,000 a year. Age limits, once a kid turns 18, you can't put money in anymore. They have to use it by the time they're 30. But you can pick specific securities. That's great. That's the differences. Now, the same. Both of them, the money goes in after tax, which you need to pay tax on it. Post-tax, it grows tax deferred. And when you take it out, it comes out tax-free if you use it for education. Remember, covered L for any level of education. 529 is only for really college and up to 10 grand for sub-college. Okay, you have to know present value, future value, discounting periods, right? Don't worry about the math so much. But present value is what we have to invest now to get to a future value. Future value is what an investment now will be worth in the future. Discounted cash flow is the method to find present value. So look, if I think I'm earning 5% on my return, and I have my $1,000, I'm gonna, and say it's for 5 years and I'm earning 5%. I'll do 1,000 times 1.05, then that number times 1.05. That times I want to keep doing that for 5 years. If I get future value and I want to find the present value, I divide by 1.05. If it's 8%, 1.08. If it's 9%, 1.09. Okay. I have find my time value of mini video. So if I get a future value and I go, what's it going to be worth today? Say I have a future value in 3 years, and what's the fair value? What's the present value today? I'm going to take 1,000 divided by 1.0, whatever the inflation, whatever the rate is, and bring it back. That rate of return is called internal rate of return. If the market price is below that present value, it's a positive NPV and worth investing. If the market price is higher than the present value, it's a negative NP and not worth investing in. Remember, nominal is coupon. Real rate of return is minus inflation. Holding period and total return are the same thing. It's growth plus income divided by original. Annualized is you're taking whatever the return is and either stretching it to a year or shortening it to a year. That's annualized. What it would be if it was by the year. After tax return, you take the return, multiply it times by the 100 minus the tax bracket. If you earn $800 and then you're in the 20% tax bracket, you do 800 times 80%, 100 minus 20. That's going to give you $640, and that could be the number, or you divide that by the original. So again, you put 10 grand in, you make $800. You're in the let's say you're in the 20% tax bracket. You times 800 times 80. I think that gives you, I don't know. I'm saying it's 64, but I don't know. I'll do it. 800 times 0.8. Yeah, so that's $640, and you divide that by the 10 grand. That's 6.4%. Okay. A tax equivalent, you take the return and you divide it by 100 minus the tax bracket. Okay. Duration, you won't have to do the math, just know it's volatility. Current yield, you will have to fucking know. It's assets, AMPs, currents of AMPs, AMP, annual over market price. Credit spread, just understand that the credit spread is the difference between treasuries, which is safe, risk-free kind of, and corporates. They measure that yield. If it's getting narrower between the corporates and the treasuries, the yield getting narrower, that's a sign of a good economy. If it's widening, remember, widening equals weakening. So if the spread's getting wider, it's a weakening, not a weird economy, a weakening economy. Normal means that the lower yields are higher than the longer yields, right? So normal yield curve means, I don't know if I'm going the right way. Normal yield curve means that the shorter term are lower yields, and the longer ones are higher yields. Inverted means the short is higher, which is not normal, and the long term is lower. That's usually a sign of a recession coming in. Okay. Duration, again, longer maturity, higher duration. Lower coupon, higher duration. Current ratio is current assets minus current liabilities. Quick ratio is current assets minus inventory over current liabilities. Now, income statement is revenues and expenses. Balance sheet is assets and liabilities. That's really what it is. Mean, median, and mode. Okay, mean is the average. Median is the middle. Mode is what shows up the most. I think that works. We've done the accounts. And don't forget, everything's going to be kind of like out there and all over the place because I'm just giving you feedback from what people are seeing, not questions, but like ideas of what to work on. So it's not always going to be like, oh, it's this and this and this. It jumps around a little bit. So remember, if you're anything about a forward rate, basically they're asking about the implied future rate if you look at a yield curve. So if you see that the yield is normal, that means the low rates are, those short rates are lower, the long rates are higher. That's normal. That means eventually it's probably going to go to the other way, where eventually the shorter rates will go up. And that usually means the Fed is going to start raising rates. And then if you see an inverted yield curve, that means the Fed is going to start lowering rates. Okay, back to this real quick. Joint tenants versus joint tenants rights to survivorship. Money goes to the other person in the account. Tenants in common goes to the estate, the heirs, the beneficiaries to probate. TOD is best for individuals. It goes to a beneficiary, supersedes the will, and does not go through probate. Now, different kinds of things. Sole prop is a single person, one person. If you see the word two people, that's really two words. If you see more than one person, it can't be a sole prop. Sole prop offers no protection, okay? But it's easy and cheap to set up. Sound like some of my old girlfriends. I'm totally kidding. Don't cancel me for that shit. Okay, don't know how I got dates with them because they were easy. Now, again, LLC, multiple, one person or multiple people. You get limited liability, not a lot. You get a lot of protection. And the money passes through gains and losses. Partnership is the same thing, but remember something. If they say partnership, they mean general partnership. They will absolutely say limited partnership if they mean limited. And why that matters. A general partnership means they're all general partners, even though it's the word partnership, which means they all have unlimited liability. If they say limited partnership, the limited partners have limited liability. The general partners have general liability, unlimited. And remember, they all get pass-through of gains and losses. An S Corp, that's a max of 100 shareholders, pass-through of gains and losses, which means you get write-offs, max of 100 shares, okay? And they have to be U.S. residents and individuals. They can't be corporations or foreign residents, because then if they do that, if they have anyone that's a non-resident or a corporation, then it has to be taxed like a C Corp, which means C Corp means that it's the best way to raise a lot of money, very expensive, but it's the best way to go big, but it is going to be double taxed because the actual corporation is the first of it, of all the things we talked about in the last 30 seconds, which I swear is a long time. C Corps are taxed as an entity, and then they pass through in the form of dividends, and then you pay tax on that also. So keep that in mind. Okay, now, trust revocable versus irrevocable, okay? Revocable means that the grantor sets it up. It's still part of his estate. So if he dies, she dies. It's part of their taxable estate, but they can take the money back and change all the shit as it goes on. Usually a living one, usually inter vivos, where you do it there. Now, but if I did a trust, I would make it irrevocable because I don't want that on me. Irrevocable means once it's in there, it can't be touched. UGMA, UTMR, they're not trust, but that's irrevocable. Once the money's in there, it's the trust of the kids, not yours anymore. You lose it. But again, when you die, it's not part of your estate. Revocable means you can change it. Irrevocable, you can't. Now remember, a living will does not avoid probate. A living will is literally for your medical stuff, like do I unplug it or not? Okay. If you want, you do the trust for you want privacy. So if a client wants to leave something to the boyfriend or girlfriend discreetly, you set up a trust. Okay, here's some one-hitters, kind of like we're doing anyway. 457, let me know that. Best for government employees, firefighters, police, no early termination. IRA penalties, we already went through the exceptions for if you pull the money out of an IRA early. We went through that list already. RMD, you know it's the April 1st after you turn 73. If you want to do ERISA, 404C, that's where the administrator of or the sponsor for the retirement account, okay, can't be sued if they give them the ability to at least 3 different choices of risk for investments, the ability to choose and change every at least quarterly, like adjust their shit, and education. They give those 3 things, then they can't be sued if the shit goes bad. Having them buy your own, the company stock is not part of it. Okay. Remember, if someone dies, they step up the cost basis. If it's a gift, it's called carryover, which stays the same. Remember something. Everything happens in December. The broker dealers, IAs, IARs, agents, their thing ends on December 31st. Remember that. So if they start in April and then they re-register in April, they just spent 4 months unregistered, which is because even if you start December 2nd, it ends on December 31st. Even if you just start December 30th, it ends on December 32nd. Okay. Now, mutual, again, one hitters. Mutual fund. Will the redemption of a mutual fund or moving from one fund to another? Again, the whole point here is that if you have a mutual fund and you move from one fund inside the family to another one, or you redeem your mutual fund shares, that is taxable if you sold it for more than your cost basis, right? So if you buy into the Fidelity large cap and you move into the Fidelity mid cap, if you move it, you won't pay a sales charge. That's the exchange privilege, but you may have to pay taxes if you redeemed it for more than you paid for, more than your cost basis. Good. Okay. SPACs. What I have videos on. What's a SPAC? It's like a blind pool, but it's not exactly a blind pool. You put the money in. Okay. It's basically you put the money in and they're going to find a takeover target within 2 years. The money's held in a trust. I have videos on this. The money is held in a trust. If you don't get the money back, if they don't find a firm to take over and being public, usually a reverse merger kind of thing, then or some version of that, you get your money back. Okay. The problem with that is it could be 2 years where the market went up a lot. See these things going up, you're missing out on that. So you actually have opportunity cost risk. Okay. Now, what else can we talk about? Okay. You got to know about ETNs, ETFs, UETs, read them up. Remember, ETN is considered debt. ETF is not debt, it's equity. Remember, so the risk that an ETN has is default risk that an ETF does not have default risk. They both track an index, they both trade on exchange, they're both pretty liquid. None of them really paid to the end. So ETFs are tax efficient. ETNs are debt. Again, an ETN is I lend you money. 30 years from now, you're going to pay me back. Okay. And you're going to pay me whatever the interest is over that, whatever the index we're tracking is over that time. So I get nothing during the life of it. It's a long-term thing. It's not for income. Remember that. Okay. Remember, UITs, they're like a mutual fund a little bit, but they're not managed. They're supervised. They have a fixed portfolio and they mature on a date. This is shit should you know already. UITs basically have a maturity date. Most of the stuff I'm talking about, you have to know. Okay. If a client wants to increase capital, let's say they're talking about options and they want to increase capital, add yield, increase return, you're going to basically sell a call. Okay. A restricted stock, that's usually for like a Reg D. If you buy a Reg D, your restricted stock is you have to hold it for 6 months fully paid, and then you can sell it after that. Okay. Control stock is different. Control stock is if you're a PODS, partner, officer, director, or big ass shareholder, more than 10%, you have to follow the 144 rules. That's more of a federal thing. I don't think they're going to go into it. Much more about restricted stock that you can't sell it for however many days. Okay. Now 6 months. Okay, so what are some things that are exempt? We have a video on this. Treasuries, munis, commercial paper, under 270, minimum $50,000 denomination. An insurance company, if the variable life insurance is not exempt, but buying their bonds or stock is, okay? Banks, anything issued by a bank, religious, nonprofit, charitable, anything on an exchange, there's a whole list of that shit. I'm not going to go crazy on that. Okay. Now let's do a little math. I'm going to show you something that may or may not show up. Okay, so you get some version of this. Total calculate overall return. So you invest 10 grand in 3 different companies, right? And we're going to figure out what the overall return is. So let's do the math. So you invest 10 grand, you lose 20%, so you lose 2 grand, right? And then you got a $200 dividend. Plus, that's a plus, right? So you lost 1,800. And this is all you're going to do. Okay, the next one. Up 5%. So now you made 500, right? And you got a $600 dividend, right? Plus $600. So you're now, remember, this is negative 1,800. Now you're plus 1,100. And then the next one, you made 7%, which is $7. To change this to a plus, just so you guys have it. And no dividends. So if you go, okay, we lost 1,800, but we made 11 and 7. Well, this is 1,800. So we lost 1,800 and made 1,800. That would be a 0 return. So the answer would be 0 in this. In case you see a question like this, just do it step by step. That's all you have to do. So let's say your client, you have 27 grand left and after you lose money on a tech stock, you want income, maybe an immediate annuity is the answer. Okay. So again, if I'm 40% money markets, 50% bonds, and 10% stock, and I'm 85 years old, that's probably a good makeup. I wouldn't touch that. If anything, maybe add more bonds to make sure they have money. Okay. Remember something. So if someone wants to redeem their mutual fund and move it, you have to follow suitability rules by finding what's matching and keeping them in the same fund family. Again, if you're going to move them out of the fund family, but there better be a damn good reason, okay? There better be an incredibly good reason to move them out of the fund family, because there really is no reason to do that, okay? Because you're going to have sales charges and they're not going to honor that, and that's not going to be a good thing, okay? Okay, so if you were listening before and you heard me say it's going to be the end of the video, that's a trick. You had to be paying attention. I'm actually going to put the link here for the unlisted video, which is going to be a magic thing for you. It's a bunch of questions that you might get the same vibe as the real test. So don't go to the end, but then look for the link. Look for the link here. I maybe put it a second time. It's an unlisted video that you will only get if you saw this link. I will see you later. Let's fucking go. Social media influencer. So maybe there's a social media influencer and you're telling them what to do with. They're not making disclosures. That could be considered market manipulation if you're using an influencer to move a stock up and down. If you're on vacation as a rep, can you solicit clients? Yes, if they're on vacation or you're on vacation. As long as it's temporary residency, you're okay. I'll get to the CE stuff. Okay, now, if an investor wants to buy gun stocks but not worried about political risk, that's not political risk. That's ESG or social criteria. Okay. Now, most likely values. Okay. Now, tenants in common, deceased goes to my estate, it goes through probate. A trade deficit. Okay. If investors are spending, remember, we'll see maybe questions on this. If you have a trade deficit, if U.S. investors are spending money in another country, that leads to the deficit. If foreign investors are spending money here, that leads to a surplus. Okay. Remember, small cap is Russell 2000, not the Dow Jones, not the S&P 500. Okay, again, ERISA, if you want to be protected, you have to offer different asset classes, equity, bond, cash, stuff like that, and give them education and the ability to change every quarter. Okay, back to this. I think we're good. Hedge funds versus venture capital. Okay, hedge fund is long. They could be long, short. They use arbitrage. They use leverage. They're looking for absolute returns. They're lightly regulated, usually under a Reg D. Only accredited investors can buy, and they can have some non-accredited, but very limited. They're very liquid with lockup periods, okay? But they're looking for absolute returns. Venture capitalists sounds the same. They usually invest in early stage startups. They're extremely liquid, very, very long time horizon. Again, like a Reg D, pretty much accredited investors, and they're looking for like big returns. Early stage, a much longer time frame, like hedge funds, 6 months, a year, whatever. Venture capitalists, 5 to 10, 15 years. Okay. QDIA, qualified default investment alternative. If you open up a 401k and you don't make a choice on anything, it will automatically pick age-appropriate, diversified, and long-term focused funds for you automatically. An example is like a target date fund or a balanced fund. Like a balanced fund always keeps you balanced, right, between stocks, bonds, and preferreds, right? Or a managed account. But big one is a target-based fund, right? So say you're 25, they're going to be much more in equity. As you get older, they do more bonds and less equity, and they adjust automatically. That's a QDIA, okay? If you do, this kind of protects you under ERISA, because if you, as the sponsor, because if you do if the QDIA goes into effect, it's going to put them in an appropriate, hopefully, investment choice, even if they don't choose one. QDRO is for divorce, okay? It splits a retirement plan for child support, divorce, shit like that. The plan administrator will have to read it and approve it. You can take the money out with the QDR without the 10% penalty if they roll it over, okay? If so, they get it. They usually have 60 days, like a wife or kids. They have 60 days to roll it over into another retirement account. This is for 401ks, not for IRAs. Okay, now a QCD, qualified charitable distribution. Okay, this is where if you want money coming out of your IRA, you can never go into a charity right away. But there are limits, right? It's like you can only do 108 grand a year. It's used basically, you can use this to satisfy your RMD without getting taxable income because you take the money out up to 100, 108, whatever it is, a year. They may just say up to the distribution amount. You take the money out of your IRA, you send it to a charity right away, and then you don't have to worry about your RMD, okay? Because it's not taxable. Maybe you don't have enough money and you don't want to take the money out, so you donate to charity, you get the deduction and all that shit. Now, this is a weird one. You must be 70 and a half. I know that's the old RMD number, but RMD is normally 73. They didn't upgrade it. It's still 7.5, which was the original RMD from like 5, 10, 15, 20 years ago. So again, a QCD is a direct transfer from an IRA to a qualified charity. It probably can't be your charity. It's to help retirees satisfy their RMD requirement without having to pay taxes or increasing their taxable income. That could be more of it. Okay. Nasaa. Remember, so any state that adopts this, you have to do at least 12 hours of CE every year. 6 hours of products and practice, which can FINRA. So now 6 hours of products and practice. If you're duly registered and you do FINRA CE, you can use it for that 6. Now, the other one is 6 hours of ethics and professional responsibility, fiduciary duty, shit like that. Half of that, 50% of that must be ethics, okay? So of the 6, 3 have to be at least ethics. So even if you're duly registered, you can only use the FINRA stuff for the products and practice, but only that 6. Okay. You can't carry forward unused hours. Now, CE is tied to registration. If you don't finish your CE by the end of the first year, you're either called deficient or inactive. Okay. So that means if you don't finish by the end of the year, you have another year to complete all of it, even the previous year. So let's use an example. End of 2025, you don't complete the 12 hours. You're now CE inactive. You can still work and all that stuff, but then you have until the end of 2026 to get both 25 and 26's CE done. If you don't get it done, you will not be able to renew. Good. Ethics, fraud, and elder abuse. So now these are red flags. An elder withdraws a big amount. Family pressure suspected. You delay, notify maybe notify the administrator, maybe. Definitely if you think they're being fraud, you notify senior protection things. Okay. What else can we do with that one? You can do 15 days, a hold for 15 days on either distributions or trading, another 10 days, and another 30 days. Okay. Moving on. And again, who are specified adults? Anyone over 18 with mental incapacity or anyone over 65, they should get a trusted contact person. We can't make them, but if they don't get it, you should notify. Moving on from this, a client cannot waive the IA's duty of care. Okay, if they try to waive it, like an exculpatory clause, they cannot waive the duty of care because the fiduciary always have to take the prudent investor rule, the duty of care. I have to care for you. I, as a client, cannot waive that for you. Okay, inside information. You can do the trade if your decision was made before you knew the inside information. So let's say you place an order and then 2 minutes later you find out, right? You decide to buy shares, 5,000 shares of IBM. And as you're entering the order, or right before you enter the order, but they've already said they want to do it, then you find out inside information, you can still place the order. Okay. Front running is jumping in front of a customer order or trading ahead of a research report. They will be tested on that. Tax equivalent yield, I talked about already. Okay. I have some questions. Some of these I'm going to do. RMD. Okay. Proceeds from an IRA are included in your state taxes. Okay. I think that works. If you get audited, you want the unqualified opinion. Pay attention to what I'm saying. Okay. If you're sending statements, if the IA is sending statements to the client, that means they have custody. They need a surprise audit. Okay. Remember something. Record keeping is for 5 years minimum. All record keeping for IAs is at least 5 years, not 5 years exactly, at least 5 years. Soft dollar, it has to benefit the client. You're going to see the word audit a couple of times. If you have custody, you get an audit. Okay, that's the big thing. Okay. Now, IAs, IARs, and agents cannot lend to clients unless they're a lender. The whole lending borrowing thing is not available to them unless it's an affiliate of the firm or their lending institution. Broker dealers can lend to clients all the time, any client under Reg T, margin rules. And you have to let them know, if I lend money under margin, increase risk, increase reward, but also increase risk because you're leveraging. Okay. An investment advisor can't pay a former rep trailing commissions if you're not licensed unless they sign an agreement ahead of time. Okay. Advertising, it's considered advertising if it's sent it to more than one person. If it's up to 10 people, you have to keep a record of who you sent it to. Over 10, just keep a record of what you sent. If you give someone a chart or some sort of tool, you have to disclose the limitations and the difficulties of it. SEC 1092, just know that they add in, if you're giving investment advice and you have to register, if you're a pension consultant, financial planner, or sports agent, okay? If it's regular, compensated, and involves securities. If the sports agent is literally just helping you sign contracts, don't really fucking care, okay? Private fund advisor, that's if you're only advising private funds, hedge funds, venture capitalists, PE firms. As long as your assets AUM are under 150, you're an exempt reporting advisor. You still have to report by filing an ADV, but you don't have to register. That 150 number is not for venture capitalists. You could be $1 billion VC and you don't have to register. The state can require higher net worth or bond requirements if they have custody. Pretty much, surety bond is only for custody, but discretion is 10 grand usually. Full custody or full discretion is usually 35 grand. Okay. If you have discretionary authority over accounts, you will probably have to put a surety bond or held to a higher net worth. You are excluded from the definition of an IAR if you only give ministerial or impersonal advice and you're not compensated in any of this shit. Okay. Now, cybersecurity, there's 5 points. Somebody got a question on this, okay? So on cybersecurity, there's five things you got to worry about. One, you have to identify. Understanding and managing cybersecurity, you got to identify the risks that are for your firm. You have to protect, which means you have to have some sort of safeguard to protect the controls, data security, and have training. That's where they send the link to you, and you got to don't click on the link. Detect, you have to be able to find when there's an intrusion or unauthorized activity. You have to have a thing responding, how you're going to respond. Outline the actions when the cybersecurity event happens, because it's going to happen. And then how do you recover, how do you restore the capabilities? So identify, protect, detect, respond, and recover. Sounds like stop, drop, and roll. Sounds like dip, duck, cover, and dip. Okay, now, identify, find the risks. Protect, how do you safeguard them? Detect, how do you find them? Respond, how do you respond to it? And recover is how do you fix this shit? Okay. Now, thank you very much. That's the end of the video. Hopefully it's around an hour. It's called my Series 66 Quick and Dirty Power Hour. I will see you later. Hopefully you got an idea of what the Easter egg is. If not, go watch it again. We'll find it. I will see you guys on the flippity flop side. Adios. Have a great night. Haha, you fell for it. You didn't watch the whole video because I did a fake out. If you made it this far, that means you didn't get to the rest where I gave you actually where the unlisted video was. You got to go back and find it. It's not too far back. I'm not that much of a dick. But you got to go back and find it because it's not at the end of this video. It's an unlisted video that you will have to find in a link from this video. Let's go and go. I got to be a little funny. See you later.